It's one of the biggest financial illusions of our time. You look at the price of your home going up and you feel richer. You celebrate the rising numbers on real estate websites and assume the market is booming. But here's the uncomfortable truth. Your house didn't suddenly become more valuable. The dollar simply became weaker. And what feels like wealth might actually be a warning. Before we go deeper, let me ask you something quickly. From which country are you watching this video? I'm curious how your local currency has been behaving over the past few years. Drop it in the comments below. Now, back to the illusion. Homes don't magically rise in value at the same time across every city, every region, every income level. Real estate doesn't suddenly transform into gold overnight. What does change quietly, relentlessly is the currency used to measure it. If the measuring stick you're using gets smaller, everything you measure with it appears bigger. And that's exactly what's been happening to the dollar. Think about it this way. If a gallon of milk costs twice as much today as it did a few years ago, does that mean milk is now more valuable? No. It simply means the dollar buys less milk. We call that inflation. But when the exact same thing happens to houses, people don't see inflation, they see wealth. And the entire system benefits from that confusion. Let's look at an example. Imagine someone bought a home for $225,000 back in 2019. A few years later, that same home is listed for $315,000. On paper, that looks like a 40% return, an incredible investment. But did the property actually improve by 40%? Did the neighborhood transform? Did the walls get stronger? Did the roof reinvent itself? Of course not. What really changed was the buying power of the dollar. This is the silent tax that nobody votes for. The wealth transfer nobody notices. And it's the trap that keeps middle-class families thinking they're winning when, in reality, they might just be running in place. To really understand this, we need to look at how money actually works, not the simplified version we learned in school, but the mechanism used in the real world. Every single dollar you hold loses a tiny bit of its purchasing power the moment more dollars are created out of thin air. It's simple: supply and demand. Increase the supply of money, and each individual unit becomes weaker. It takes more of them to buy the same house, the same car, the same groceries. That's why home prices across the country often seem to rise at the same time. Not because millions of houses magically improved overnight. It's because the denominator in the equation changed. The asset, your house, stayed the same. The currency, the dollar, fell in value. Yet psychologically, we celebrate. We feel smarter. We feel successful. We feel like the system is finally working for us. But here's the twist. If your home rises in price, but everything else rises even faster, your energy bills, your food costs, your health care, your taxes, you didn't actually win anything. You simply preserved a portion of your purchasing power while the dollar slid downward. The system prefers this illusion because it keeps people calm. If the government called this what it truly is, currency devaluation, people would panic. But when they call it a hot housing market, high demand, or strong economic growth, people feel reassured. The truth is, no politician wants to explain that creating new money reduces the value of the old money everyone has saved. No bank wants to admit that your savings are losing purchasing power year after year just by sitting there. And no central authority wants the public to understand that inflation is not some natural force of nature like gravity. It's a policy choice. And when people don't understand this fundamental concept, they start making decisions based on illusions. They take on bigger and bigger mortgages because they believe the myth that home prices only ever go up. They stretch their budgets to chase a feeling of wealth that doesn't actually exist in real terms. They celebrate the paper gains while ignoring the shrinking power behind the paper itself. Let's take this one step further. When a currency weakens, everything priced in that currency has to rise. Food, rent, tuition, medical care, And yet, but notice how we react. A house price rising is seen as good. Everything else rising is seen as bad. That contradiction alone shows how deeply currency devaluation hides in plain sight. Real estate especially gives the illusion of prosperity because it esses a large number attached to a big, tangible asset. If your grocery bill doubles, you're angry. If your home price doubles, you're proud. But the underlying reason for both is exactly the same. The dollar fell. And here's why this matters today more than ever. Over the past decade or so, massive amounts of new currency have entered the system through stimulus checks, quantitative easing, and government borrowing. That new money doesn't spread out evenly across the economy. It flows into certain areas: first banks, large corporations, and financial assets like stocks and real estate. This pushes up the prices of those assets long before wages have a chance to catch up. That's why so many people feel like they're falling further and further behind, even when they're working harder than ever. It's not the house that changed. It's the money. And once you truly understand this, you start to see the entire economy differently. You see through the illusion that makes people think they are building wealth, when what they were actually doing is desperately trying to outrun the speed of devaluation. You start realizing that your home, your investments, your savings, everything depends on the health of the currency behind them. Most people never learn this. They spend their entire lives believing they're regrowing richer while the currency is quietly erasing their progress. They measure their success in dollars instead of in purchasing power. They celebrate numbers instead of actual value. And this huge misunderstanding has created one of the biggest traps in modern finance: the belief that real estate always goes up just because it's a good investment. But if an asset only rises in price because the currency it's measured in fell, then the asset didn't really rise. It merely kept up with the weakening money supply. The harder truth is this: for many people, they didn't actually make money on their homes, they just avoided losing as much purchasing power as everyone else who was holding cash. When you start thinking about it from that angle, the entire picture becomes much clearer. Homes don't rise. Dollars fall. And the people who understand this stop chasing higher numbers on a screen and start focusing on preserving real, tangible value. But if this is the case, who actually benefits from this grand illusion? And why is the system designed to work this way? Who really benefits when home prices go up? To figure this out, we have to follow the money right from the moment it's created. When new money enters the financial system, it doesn't land in your bank account or mine. It first flows through major banks, large institutional investors, and government channels. These groups get to use the new money while it still holds its full purchasing power. By the time that money trickles down to the average worker through wages or stimulus, prices have already started to climb. This is why inflation often feels like a slow, painful grind for the working class, but a wealth amplifier for those who are already wealthy. If you've ever looked around and wondered why the gap between the rich and everyone else has widened so dramatically over the last 50 years, this is a huge piece of the puzzle. Owners of assets get the benefits early. Wage earners pay the costs later. Now, let's connect this to real estate. Real estate is one of the most leveraged asset classes in the world. What does that mean? It means people rarely buy homes with a suitcase full of cash. They use debt, a mortgage, and here's the crucial part. Debt becomes easier to pay back when the currency it's denominated in gets weaker. Think about it: if your mortgage payment is a fixed $2,000 a month, that $2,000 is a lot easier to come by when a loaf of bread costs $10 instead of $3. This creates a system where governments, banks, and big investors all have a quiet incentive to let the currency slowly lose its value. For governments, a weaker dollar makes it easier to pay down massive national debts without having to make the unpopular decision of dramatically raising taxes. They don't have to announce it on the news. They just let inflation do the heavy lifting silently behind the scenes. Meanwhile, the public sees the value of their homes going up and celebrates. They feel richer. But they often do realize that the profit they see on paper is just a reflection of the hidden tax inflation that they've already paid in the form of higher living costs. But the impact goes much deeper than that. When home prices rise because the currency is devaluing, it creates a massive barrier for younger generations. Families find it nearly impossible to get on the property ladder. The average person ends up spending a much larger chunk of their income just on a place to live. This isn't a sign of prosperity. It's financial compression. It's a system tightening its grip on anyone who doesn't understand the rules of the game. This leads us to another powerful illusion: the belief that just owning a home is an automatic path to building wealth. But if home prices are rising much faster than wages, are new buyers really building wealth? Or are they just transferring their future earnings to previous generations and to the financial institutions that hold their mortgages? It's a massive shift of power, cleverly disguised as an opportunity. Let's zoom out and look at history for a second. Whenever a currency has been weakened, whether slowly over decades or aggressively in a crisis, people have always fled into real, tangible assets. Things you can touch: land, precious metals, commodities, anything that can't be created out of thin air with a few keystrokes on a computer. This isn't just wild speculation. It's a basic survival instinct for your wealth. When you finally understand that your dollar is consistently losing purchasing power, you stop asking, "Why did houses get so expensive?" And you start asking the real question: why is my money failing to keep up with reality? This mental shift is what separates those who just get tossed around by financial waves from those who actually understand the tide and how to navigate it. But here's the twist that most people miss. Even though your house might not have truly risen in fundamental value, owning real estate can still be a powerful way to protect yourself. If you understand the game being played, a house isn't valuable just because the market says so on any given day. It's valuable because it represents things the government can't print: a piece of land, shelter, utility, and scarcity. The real danger comes when people mistake this currency illusion for their own investment genius. They start to believe their brilliant decisions made them rich. They think they timed the market perfectly or picked the best neighborhood. But in so many cases across the country, the currency simply fell fast enough to make almost everyone who owned a home look like a financial wizard. This misunderstanding can lead to incredibly risky decision-making on too much debt, speculating on properties, and leveraging up to the hilt based on the belief that real estate always goes up. But nothing goes up in a straight line forever, especially in a world where currency cycles can shift dramatically. Let's dig a little deeper into this mechanism. When the dollar's value falls, real estate becomes more expensive, not because it's suddenly a better house, but because it acts like a sponge, soaking up all the excess currency that's been printed. The new money sloshing around the system needs to find a home. Literally. This is why we see asset bubbles form. It's not just fueled by greed, although that plays a part. It's also driven by the desperate search of capital to protect itself from a shrinking dollar. This cycle continues until something eventually breaks. Affordability collapses for the majority, interest rates have to spike to combat runaway inflation, or the currency weakens so quickly that the system can no longer handle the instability. And this is where understanding true purchasing power becomes absolutely critical. Let's use a simple example. A house that cost $150,000 20 years ago might sell for $450,000 today. On paper, it looks like it tripled in value. But did it? The dollar simply lost 2/3 of its purchasing power over that time. If that same homeowner sells the property and tries to buy back their original lifestyle, the same quality of car, education for their kids, healthcare, food, energy, they would quickly realize that their supposed profit evaporates into thin air. The real measure of your wealth is not how many dollars you have. It's what those dollars can actually buy. Once this concept truly sinks in, you start to see the entire financial world with new eyes. You begin to question the headline numbers you were always taught to celebrate. You stop measuring your success in these fake, inflation-driven gains. You stop believing that higher prices automatically mean higher value. And most importantly, You start looking for ways to protect your purchasing power instead of just chasing a higher number in your bank account. So, what does this all mean for the future? If the trend of currency devaluation continues, we can expect home prices to keep rising on paper, not because our homes are becoming fundamentally more valuable, but because the unit of measurement, the dollar, is shrinking. This means the next few years could feel like a boom for existing homeowners, but a complete disaster for renters and anyone trying to buy their first home. Understanding this dynamic is the first, most important step toward escaping the illusion. The next step is to learn how to store your wealth in things that cannot be easily created, or manipulated things, like productive assets, scarce resources, valuable skills, and yes, real estate when it's used correctly as a store of value and not a speculative gamble. Because in the end, the most dangerous financial belief you can hold is that rising numbers on a screen equal rising wealth. Your house didn't just triple in value. The dollar fell. And once you truly understand that, everything else in the world of finance suddenly starts to make a whole lot more sense. If this perspective was helpful, let me know your thoughts in the comments below. Sharing your own experiences helps push this important conversation forward. Thanks for watching.